Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down one of the most interesting companies on the market, the global pizza giant, Domino's Pizza, trading under the ticker symbol DPZ.
Oh, absolutely.
Yeah.
It is a really fascinating asset to tear apart right now.
Yeah, we are looking at a real-time market cap of $9.92 billion and a current price of $298.18 as of late June 2026. On the surface, this is an asset-light cash machine with a historically unassailable fortress of supply chain logistics. But the real question for us as long-term investors is this. Has their technological edge been completely commoditized by delivery aggregators, turning a legendary growth compounder into a value trap? Are there hidden cracks in the fortress that the market is ignoring? That's what we're here to find out.
That's a huge topic. Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now let's get into it. Pillar number 1, the business model and unit economics. To really understand what we're dealing with here, we have to look past the physical pizza box.
Right, because everyone just assumes it's a food company.
Exactly. When you or I order pizza, we see a food business. But when you look at the corporate financials, you realize you're looking at a heavily asset-light franchise ecosystem.
Let's slow down and translate asset light for the listener, because when you drive down the street, a Domino's store is a very physical asset.
Oh, for sure.
It's brick, mortar, big commercial ovens, signage, delivery cars. So how exactly is corporate asset light?
Well, because corporate doesn't actually own any of that.
Yeah.
If you decide you want to open Domino's tomorrow, you are the one taking out the massive small business loan.
Right, the franchisee takes the hit.
Exactly. You are signing the commercial lease, you are buying the $30,000 vends, and you are hiring the staff. The local operator, the franchisee, takes on nearly 100% of the physical capital expenditure and operational risk.
Wow.
Yeah. Corporate takes essentially none of it.
So wait, corporate just sits back and collects a check?
More or less.
Right.
I mean, the local operator pays a hefty initial franchise fee just to get the blueprints and the right to put the logo on the building.
Okay, a one-time fee.
Right. But the true financial engine of this company, the thing that prints money for shareholders, is the running royalty fee. Every single time a franchise sells a pizza, 5.5% of that gross sale flows directly back to corporate.
I really want to highlight the word gross there because it's a critical distinction. They aren't taking 5.5% of the profit, right? They take it right off the top line. Why is that so important?
Because it completely insulates the corporate entity from local operational headaches. If a franchisee is terrible at managing their labor schedules, or say they leave the lights on all night and their utility bill spikes, corporate literally does not care.
They still get paid.
Exactly. Their 5.5% cut is secured the exact moment the customer's credit card swipes. They don't have to audit the franchisee's toilet paper expenses to figure out what their cut of the profit is. They just take pure revenue.
That's incredible.
It is. And on top of that, franchisees are actually mandated to contribute another percentage to a national advertising fund.
So corporate gets this highly predictable, multi-weekly recurring revenue stream that is entirely driven by a consumer habit. You think of it as selling food, but we should really think of it like a software as a service company.
I like that analogy.
Yeah. Corporate is Microsoft. They license the operating system of pizza making to the independent franchisee, who kind of acts as the hardware. And corporate collects a subscription fee on every byte of data or every pizza processed through that hardware.
That's a really good way to conceptualize it. And look, when times are good, it's a beautiful setup. The entire model relies on transaction frequency. You don't just order pizza once a year, right? It's a Friday night ritual.
It's game day.
Exactly. It's what you order when you're working late. It is completely baked into the weekly rhythm of the middle-class consumer.
But the middle-class consumer is, they're hitting a wall right now. And this brings us to the macroeconomic headwinds. We are seeing some very real structural degradation in that transaction frequency. People just have less cash in their pockets right now.
Discretionary spending is absolutely tightening.
Yeah.
We're looking at a broader macroeconomic environment where lower income and middle income consumers are experiencing severe budget constraints.
Rents are up, groceries are up.
Right. Inflation on essentials like rent and utilities means something has to give. And when we look at the data, we are seeing evidence that the traditional pricing power this company enjoyed is, well, it's hitting a ceiling.
Let me throw some numbers at you to ground this for the listener. If you look at global retail sales in 2025, they grew at a healthy 5.4%. You'd expect a dominant mass market player to ride that wave.
You would.
But if you zoom in on Domino's recent Q1 2026 metrics, their U.S. same-store sales growth essentially hit a brick wall. It slowed down to just 0.9%.
And we really need to unpack what 0.9% means in this context because, on the surface, growth is growth.
You know when inflation is running higher than 0.9%. If same-store sales are up 0.9%, but the cost of everything else is up 3%, your real growth is actually negative. You are losing ground.
Yeah, you're shrinking in real terms.
Exactly. And historically, their target for same-store sales growth has been around 3.0%. So 0.9% is a massive underperformance.
Right. And you have to dissect the anatomy of a same-store sales figure. It is generally a function of two variables: ticket size and transaction volume.
Break those down.
So ticket size just means the total dollar amount of the order, either because the company raised menu prices or customers are adding more items like, wings and sodas. Transaction volume is the actual raw number of orders walking out the door or being delivered.
And here is the flashing red light in the Q1 2026 data. Delivery sales volume actually contracted by 0.3%.
Negative volume. That is the critical metric here.
Right. It sounds like a tiny fraction, just 0.3%. But across thousands and thousands of stores doing millions of orders, a negative volume print means foot traffic is reversing.
It's a huge red flag.
It tells you that the levers they've been pulling to maintain their margins, raising prices, adding delivery fees, are finally breaking the consumer's willingness to buy. They have hit a wall, specifically in that premium home delivery tier.
I'm really glad you used the phrase premium home delivery tier, because we need to reframe how we think about getting food brought to our houses. A decade ago, getting a pizza delivered felt like a cheap, democratic convenience.
Oh yeah, it was the cheapest option.
Right. Today, getting a hot meal delivered to your couch is essentially a luxury service. By the time you pay the menu price, add the baseline delivery fee, add the service fee, and then tip the driver, a standard pizza order can easily push past $30 or $40.
It's wild. And when the consumer feels the pinch, that premium service gets chopped from the budget immediately. If you're listening to this and you've looked at your credit card statement recently, you know exactly what I mean.
Yep, it adds up so fast.
You might still want pizza, but instead of paying $35 for delivery, you go to the grocery store and buy a $7 frozen pizza, or you drive to the store and pick it up yourself to save the $8 in fees and tips.
The friction to order delivery has just gotten way too high.
Wait, I want to clarify something here. If the volume is dropping, how is the company still surviving? Why isn't the stock totally cratering? If fewer people are ordering pizza, shouldn't the whole system just collapse?
Well, that's where we move from the front-end consumer problem to the back-end corporate advantage. To understand why a company with a nearly $10 billion market cap can weather a drop in consumer volume, you have to look at the structuring machinery running underneath it.
Okay, pillar number 2.
Yes. This isn't just a brand licensing company. They are a logistical powerhouse, and that is the core of their historical competitive moat.
Okay, let's pull back the curtain on this moat, because most people assume Domino's advantage is marketing, or, I don't know, maybe the recipe. But the real moat is architectural. It's an aggressive scale economy combined with immense process power.
Let's start with the supply chain, because it is vertically integrated to a degree that most retail investors simply do not understand.
Yeah.
The corporate entity doesn't just sell the rights to the logo.
Right.
They actively operate regional dough manufacturing facilities and massive food distribution supply centers. They handle 100% of the ingredient procurement for their domestic stores.
Let me paint a picture of what that actually means in reality. Imagine you decide to open an independent local pizza shop. You need ingredients. So you call up a food distributor.
Good luck with those prices.
Exactly. You are buying cheese, flour, yeast, pepperoni, and cardboard boxes at wholesale prices, but you are buying them for one single store. Your purchasing power is basically zero. You pay whatever the distributor demands.
Right. Now look at Domino's. They are buying cheese and wheat for thousands of stores globally. They are negotiating directly with the largest agricultural producers on the planet.
The volume is insane.
The purchasing power is astronomical. They secure massive, foundational commodity discounts.
But here is the genius part, and this is what really blew my mind when I first researched their structure. Corporate doesn't gouge the franchisee on these supplies.
Yep.
They actually pass those incredibly low negotiated commodity per unit costs directly down to the local franchisee.
Why did they do that?
Right?
I mean, why wouldn't corporate just mark up the cheese and take a profit there?
Because corporate makes their money on the 5.5% top-line royalty. They need the franchisee to sell as many pizzas as humanly possible. By passing the savings down, corporate ensures that the local operator has vastly superior unit profitability compared to the mom-and-pop shop down the street.
It creates total lock-in.
Oh, completely.
The franchisee stays in the system because they literally cannot source the raw materials cheaper anywhere else. If they tried to leave the franchise and go independent, their ingredient costs would skyrocket overnight.
It'd be bad at business.
Right. It is a scale advantage that just compounds upon itself. Corporate controls the supply chain, which keeps franchise costs low, which keeps prices competitive, which drives volume, which generates more 5.5% royalty fees for corporate.
And this vertical integration doesn't stop at a truck full of dough. We have to talk about the process power embedded in their technology. Because for a long time, the real reason they dominated wasn't the cheese, it was the app.
Yes, the tech stack. They built a custom proprietary digital tech stack from the ground up. This includes their Pulse point-of-sale system and their native mobile apps.
They were way ahead of the curve.
Way ahead. They didn't just buy off-the-shelf software from some vendor. They built an internal software engineering machine. Today, over 75% of their total order intake is generated through these digital channels.
I remember when they first launched the pizza tracker, it seemed like a gimmick. Your pizza's in the oven, your pizza's in the car.
Everyone laughed at it.
Right. But the back-end reality of that tracker is a ruthless efficiency engine.
It is a hyper-optimized labor and routing system. The digital intake feeds directly into an algorithm that maps out delivery routing to hit an absolute efficiency floor.
So it's not just a cute graphic for the customer.
Not at all. The system literally tells the kitchen staff exactly when to put a specific pizza in the oven based on the real-time GPS location of the driver who is out on their current route.
Stop and think about that. They aren't making a pizza and letting it sit under a heat lamp while waiting for a driver to return.
Probably getting cold and gross.
The oven time is dynamically synced to the driver's geographic coordinates. The goal is that the driver walks in the back door exactly as the box is coming out of the oven, grabs it, and walks right back out. They are shaving seconds off the delivery time and cents off the labor cost.
It's industrial engineering applied to fast food. And for a decade, that proprietary tech stack was an impenetrable fortress. If you wanted a hot meal delivered quickly and reliably, you ordered Domino's.
Because the alternative was awful.
Yeah, calling the local Chinese place and reading your credit card number over the phone was a terrible consumer experience.
But, well, the landscape has fundamentally shifted. The fortress is under siege, and the threat isn't coming from Pizza Hut or Papa John's. It's coming from the aggregators. DoorDash, UberEats, Grubhub.
This is the critical transition in the thesis. We really have to run an anti-moat check here. For a long time, Domino's moat was widening. But over the last few years, we are seeing a structural narrowing trend.
Narrowing fast.
Yeah. The aggressive venture capital-fueled rise of delivery aggregators has completely commoditized the entire architecture of delivery.
Commoditized delivery architecture. I want to make sure the listener really grasps this because it is the single most important shift in the restaurant industry in the last 20 years. 10 years ago, the local burger joint, the family-owned sushi place, the neighborhood taco stand they could not afford to deliver.
Right. They couldn't afford the upfront capital expenditure of buying cars or the massive logistical headache of hiring, insuring, and managing a fleet of teenage delivery drivers.
It's a nightmare to run.
It was too complex. So Domino's essentially had a monopoly on the logistics of moving hot food from point A to point B.
But today, what does a local taco shop have to do to get a delivery fleet? Nothing. They literally just sign up online, put a DoorDash tablet on their front counter, and overnight, they have the exact same logistical reach and the exact same frictionless app interface as a global pizza giant.
The technological arbitrage has vanished. The consumer who used to order pizza on a Tuesday simply because it was the easiest thing to get delivered can now get pad thai, a smash burger, or a burrito bowl with the exact same level of digital friction.
It's all just one tap away now.
Exactly. You tap a button, you track the car on a map, the food arrives. The aggregators stole the monopoly on convenience.
Now, let me push back here. Because I hear this aggregator argument all the time, and, it makes sense on the surface. But we just spent 10 minutes talking about Domino's insane vertical integration and their massive commodity discounts.
Right.
Even if DoorDash gives a local taco shop a delivery driver, that local shop is still getting crushed on unit economics, right? They pay wholesale for ingredients, and then they have to pay DoorDash a massive 20% to 30% commission on every single order. Surely they cannot compete with the sheer profitability of a Domino's franchise.
You're touching on a vital distinction there. On a pure unit economic basis, you are completely correct. The unit profitability of a Domino's store is vastly superior to a heavily aggregator-reliant independent restaurant.
I mean, 30% to DoorDash is brutal.
It is. The local shop taking a 30% haircut to DoorDash is barely surviving. They often just take delivery orders to keep the kitchen busy and maintain volume, but they aren't making real margin on it.
So Domino's still wins the profit war.
They do win the profit war at the store level. But here is the vulnerability. DoorDash doesn't care if the local taco shop goes out of business, because there are 3 more restaurants ready to take its place on the app.
Oh, that's true. The platform survives.
Right. The aggregator platform itself is capturing the consumer's attention. If the consumer opens the DoorDash app instead of the Domino's app, Domino's loses the volume, regardless of how superior their internal profit margins are.
That is a terrifying dynamic for a legacy brand. It means your perfect internal economics don't really matter if the customer just forgets you exist because you aren't on the platform they use.
Exactly. However, we have to look at why Wall Street still values this company at nearly $10 billion, despite that existential threat. And the answer lies in the corporate balance sheet, bringing us to Pillar 3.
Financial alchemy.
Yes. The superior profitability of this system relies on a very specific, almost magical financial structure operating behind the scenes.
So this is where we get to talk about the real engine room. This is what Charlie Munger would call a Lollapalooza effect, when multiple different forces operate in the exact same direction to create an outsized exponential result. And the 2 forces at play here are incentive alignment and negative working capital.
Let's quickly review the incentive alignment because it sets the stage. As we established, franchisees fund 100% of the upfront retail expansion capex.
The stores, the ovens, everything.
Yep. If the brand wants to open 500 new stores, corporate doesn't spend a dime. The franchisees take the loans. Yet, corporate begins generating high-margin 5.5% royalty fees the very second those new doors open. It is infinite return on invested capital for the corporate entity when a new store opens.
But the real financial alchemy, and I use the word alchemy deliberately because it literally feels like turning lead into gold, is in the supply chain cycle. We need to explain negative working capital.
This is crucial to understand.
Because in your personal life, if your bank account goes negative, it's a disaster. You're bouncing checks. But for a massive corporation, negative working capital is the absolute holy grail.
It is the ultimate structural advantage. Let's walk through the timeline to make it concrete.
Please.
Okay, imagine corporate sells a truckload of dough and cheese to a franchisee. The franchise receives the food on Monday, and corporate immediately debits the franchisee's bank account. Corporate has the cash in hand on Monday.
Okay, cash is secured.
Right. However, because corporate is a multi-billion-dollar behemoth, they have negotiated massive extended payment terms with the agricultural suppliers who actually grew the wheat and milked the cows.
The farmers and distributors.
Exactly. So corporate doesn't actually have to pay the farmer for that cheese until, say, Friday, or maybe even 30 days from now.
So wait, corporate has the cash from the franchisee on Monday, but the bill isn't due until Friday. They have millions of dollars sitting in their bank account, completely free to use, for 4 days. And they do this continuously, 365 days a year at a global scale.
Exactly. The inventory cycles through their regional storage hubs incredibly fast. The cheese and the dough are perishable, so they are in and out of the warehouse usually inside of 3 to 5 days, but the payment terms to the suppliers stretch out for weeks.
So they are essentially being paid to hold inventory. They operate with a structurally negative working capital architecture. This capital cycle fuels an astonishing velocity of free cash flow. It literally prints money.
It really does.
And because they don't have to build stores, that free cash flow requires almost no capital intensity to maintain.
And if we look at the quality of earnings test, we can see exactly how this cash machine translates to the bottom line. Let's look at the operating margin trajectory over the last few years. In 2023, operating margins were sitting at a very respectable 14.57%. By 2025, those expanded to 15.59%.
What drove that initial jump?
Largely supply chain automation gains. They modernized the physical dough factories. They implemented better robotics in the warehouses, which required fewer human workers to load the trucks. And they further optimized the routing software for the delivery fleets. They essentially squeezed more blood from the stone.
And if we look at the trailing 12 months right now, the TTM figures, the data indicates a massive jump to a 19.18% operating margin. That is a huge expansion.
It is. But we have to be intellectually honest about where that recent jump came from. A significant portion of that 19% margin is due to the optimization of delivery fees. Meaning they found ways to charge the end consumer slightly more for the delivery service without the consumer completely revolting.
So they pulled the pricing lever, which circles right back to what we discussed earlier, the volume contraction. They pushed the margin up to 19% by raising fees, but that is exactly what caused the 0.3% drop in total delivery volume. They are maxing out the toll road.
Precisely. They are walking a tightrope here. And we cannot ignore the realities of the underlying agricultural market. While margins look beautiful today, there is very real gross input pressure right now on cheese and protein logistics.
All right, if you are running a negative working capital cycle based on cheese, what happens when the price of milk skyrockets globally?
The margins get squeezed.
Exactly. The underlying costs of those raw materials threaten their near-term domestic distribution margins. If cheese spikes, that 19.18% operating margin could compress violently overnight if they cannot pass that cost onto the consumer. And as we just established, the consumer is tapped out. They won't pay $40 for a pizza.
That is the perpetual risk of a food-based supply chain. However, there's another piece of the quality of earnings that we have to highlight because it is a massive positive for the stock, and that is stock-based compensation, or SBC.
Oh, this is such a breath of fresh air. If you look at your brokerage account right now and you own any modern software or tech companies, you're probably getting crushed by invisible dilution.
It is the dirty secret of Silicon Valley. We analyze software companies where stock-based compensation makes up 20%, 30%, sometimes even 40% of their operating cash flow.
It's ridiculous.
Management essentially masks massive unprofitability by paying their employees in newly printed stock instead of cash.
Right, it dilutes the existing shareholder. You own a smaller and smaller piece of the pie every year. But Domino's SBC is incredibly minor. It tracks at less than 4.5% of operating cash flow.
That is highly negligible structural dilution.
Yeah. When you adjust for SBC, their free cash flow conversion is completely unimpaired. The value they are creating is real, organic cash, not an accounting illusion.
Which naturally leads to the ultimate question for any cash-generative business. If you are printing massive amounts of organic free cash flow with virtually no capital requirements to build new stores, what exactly do you do with all that cash?
Let's grade the CEO's report card on capital allocation, because management teams can easily destroy a great business by doing stupid things with the cash.
Fortunately, Domino's management has historically been highly disciplined. They stay strictly inside their circle of competence. You don't see them engaging in destructive M&A.
Right, they aren't buying up random concepts.
No, they aren't trying to buy a failing burger chain or a coffee startup just to manufacture revenue growth. They avoid what Peter Lynch famously called diversification.
The hierarchy of how they deploy their cash is actually very rigid and predictable. It goes like this. First and foremost, share buybacks. Second, dividends to reward the shareholder. Third, targeted supply chain infrastructure CapEx to keep the dough factories modernized. And finally, a small allocation to R&D for maintaining the tech stack and the app.
The aggressive share buyback program is the absolute focal point of this stock's performance over the last decade. And the way they execute it is fascinating. They actually utilize debt to fuel these buybacks.
Hold on, borrowing money to buy your own stock. That sounds incredibly reckless to the average listener. Why would a healthy company go into debt just to manipulate their share count?
Because of the predictability of their recurring revenue. Remember, the 5.5% royalty stream.
Right.
It is so reliable and so immune to local store fluctuations that corporate can comfortably and safely service a very high debt load. They can issue a corporate bond at a relatively low interest rate, take that mountain of cash, buy back their own stock on the open market, and retire those shares permanently.
And when you retire shares, the remaining shares represent a larger ownership stake in the company. Earnings per share goes up, even if net income stays totally flat. But this strategy creates a wild accounting anomaly on their balance sheet, right?
It really does. If you run a standard stock screener and look at Domino's balance sheet, it looks terrifying.
Yeah.
Their accounting book equity position is technically negative. On paper, it looks like the company is totally insolvent because their liabilities vastly exceed their total assets.
Yeah, if I'm a novice investor looking at Yahoo Finance, I see negative equity and I run for the hills.
But you have to understand that this is purely an accounting artifact. When you buy back and retire massive amounts of shares at prices far above their original par value, It mathematically drives the book equity negative.
It doesn't mean they're bankrupt.
Not at all. It doesn't mean the company is broke. In fact, it supercharges their efficiency metrics, specifically return on invested capital, or ROIC.
Let's translate ROIC for a second. Think of ROIC like the interest rate on a savings account. If you put $100 into a business, how much cash does it spit out a year later? Because the capital base, the denominator, is continually depressed by these share buybacks, Domino's true economic return on invested capital hovers securely above 25%.
25% ROIC is elite, rarefied territory. And you have to compare that return against what it costs them to get the money in the first place, their weighted average cost of capital, or WACC. Currently, their WACC sits at around 8.5%.
So basically, they are borrowing money from the bond market at an 8.5% interest rate, plugging it into their pizza royalty machine, and getting a 25% return on that capital. The spread between that 8.5% cost and the 25% return is pure, unadulterated value creation for the shareholder. It's an arbitrage machine.
It is a beautiful machine.
Yeah.
But as any seasoned investor knows, you do not buy a stock for what it did yesterday.
Always looking forward.
Exactly. A company is only worth the present value of the future cash it can generate. Historical margins and current buybacks are great, but to figure out if this $298 stock is actually a buy today, we have to look over the horizon. That takes us to Pillar 4.
Right. And that brings us to the growth engines, the threat of saturation, and the valuation multiples. Where is the future structural compounding going to come from? Because management can't just buy back stock forever if the underlying business stops growing.
Well, management has outlined two primary growth engines to combat stagnation. The first is international tier expansion. They are aggressively targeting growth across 90-plus international markets.
How do they do that without spending billions of dollars building stores in foreign countries they don't even understand?
Through master franchise partners. A master franchise agreement is essentially where corporate licenses the rights to an entire country or a massive region to a single, highly capitalized local operator.
Ah, I see.
That master franchisee then takes on the burden of either sub-franchising to local owners or building the stores themselves. It is an even more hands-off, asset-light way for U.S. corporate to capture global growth. They just collect a slightly smaller royalty check from across the ocean.
The second growth engine is entirely domestic, and it's heavily focused on shifting consumer behavior. They want to expand their carryout market share, meaning they want you to get off your couch, drive to the store, and pick up the pizza yourself.
And economically, the carryout order is the absolute holy grail for a franchisee.
Break that down for us. Why does a store owner care if I pick it up or if they deliver it? Isn't the price of the pizza basically the same?
The menu price might be similar, but the cost to fulfill the order is drastically different. Think about the unit economics of delivery. You have to pay an hourly wage to the driver. You have to cover commercial auto insurance.
So what's the logistics?
Right, you deal with vehicle maintenance, gas, and the logistical bottleneck of a driver only being able to take 2 or 3 orders per hour. It is a highly variable, incredibly expensive labor cost.
But when I walk into the store...
When a customer walks into the store and carries the pizza out themselves, that variable delivery labor cost is eliminated entirely. The flow-through profit to the bottom line on a carryout order is significantly higher.
It's a massive win for the store.
And the customer isn't paying a delivery fee or a tip, so they feel like they are getting a better value, which increases their likelihood to return.
That makes total sense on paper. Push international, push carryout.
Yeah.
But so we have to administer a total addressable market reality check here, because the domestic delivery pizza sector is reaching near saturation levels. Saturation is the key word. There is a Domino's within a few miles of almost every addressable household in the United States.
Right. If you live in a suburb in Ohio, there is already a Domino's servicing your zip code. If corporate forces a franchisee to open a second store just 2 miles away to artificially boost store count numbers, that new store is just going to cannibalize the sales of the existing store.
The local franchisee won't stand for it.
Exactly. You simply cannot build thousands of new domestic stores without destroying the unit economics of the people already in the system.
And even looking at the international growth engine, management's long-term global store targets appear overly optimistic when you dig into the structural realities on the ground. We are currently seeing a wave of consolidation among international master franchisees.
What does that actually mean in practice? It means the massive operators who own the rights to, say, Western Europe or parts of Asia are buying up smaller operators. And when they consolidate, they focus on optimizing their existing portfolio and paying down debt, which naturally slows down the frantic pace of new store growth. They aren't expanding aggressively, they are optimizing.
Plus, and I think this is a massive macro factor that doesn't get enough attention on Wall Street, there's a broader cultural headwind, shift in consumer diets. We are seeing a palpable global shift away from heavy carbohydrates and ultra-processed foods.
Yeah, the health trends are real.
As health trends evolve, expanding a pure carbon cheese offering into 90 new markets at historical hypergrowth rates might face severe, localized consumer friction. You can't just assume the rest of the world wants to eat American fast food pizza 3 times a week forever.
Which brings us to the ultimate reckoning, valuation. We know this is a structurally high-quality business. It has an incredible supply chain, elite ROIC, and smart capital allocation. But we also know it's facing severe growth headwinds, consumer wallet tightening, and aggregator competition.
It's a mixed bag.
It is. So the question is, how is the market pricing those headwinds right now?
If you look at the current metrics, DPZ is trading at a 17.15x trailing 12-month price-to-earnings multiple. And if we look forward based on analyst estimates for the next 12 months, it sits at a 15.62x forward PE.
To put those numbers in historical context, that 15.6x forward multiple represents a historic 35% discount to its 5-year average multiple, which typically hovered around 26x earnings.
For the better part of a decade, this stock was priced for absolute perfection. It was treated like a high-growth tech software compounder. A 26x multiple implies you're going to grow forever.
So what is the market's wager right now? By dropping the price to $298.18 and compressing the multiple down to the mid-teens, market participants are essentially pricing in a scenario of minimal terminal growth.
They don't believe the story anymore.
Right. The current price implies that the broader market expects long-term net income growth to slow down to just 3.5% to 4.5% annually for the next decade.
3.5% growth. I mean, that is basically just keeping pace with inflation. That is a massive paradigm shift from historical expectations. The market is looking at management and saying, we don't believe you can grow like you used to. We think you are saturated.
But for a value investor, that pessimism is exactly what creates a steep margin of safety. When expectations drop that low, it doesn't take much for the company to outperform and surprise the market.
Let's walk the listener through a valuation exercise. Let's look at an intrinsic value triangulation based on the hard data. We can use 3 distinct methods to view where the price should be.
Let's start with method A, which is historical mean reversion. This is the bullish case.
Right. Method A assumes the market is currently overreacting to short-term headwinds and that the company will eventually prove its resilience and return to its historical valuation multiple. If you take their 5-year average PE of roughly 25x and multiply it by the consensus, next 12 months earnings per share estimate of $19.19, while you get an implied share price of $479.75, almost $480 a share. That is a massive upside from the current $298, but yeah. I think that is way too aggressive.
I agree.
Given the saturation risks, the consumer pushback, and the aggregator threats we just discussed, assuming they will trade like a high-growth tech stock again feels pretty naive. So let's look at Method B analyst consensus.
If we average out all the major Wall Street targets right now, we land at a median price of $399.14. However, it is worth noting that the range of opinions there is incredibly wide. The high target is $432, but the absolute lowest bear target on Wall Street is $290.
Keep that $290 number in your head, folks. Now let's look at Method C, which I argue is the most grounded and realistic approach. Simplified owner earnings. This is basically a reverse discounted cash flow model.
Exactly. We aren't guessing what multiple the market will assign in the future. We are just valuing the cash the business actually produces today. If we discount a very conservative 5.5% terminal free cash flow growth rate, and we use a standard 9% hurdle rate, which is the return we demand for taking the risk of holding the equity, the math yields an intrinsic asset value of $335.
Okay, let's visualize the spectrum for the listener. The absolute worst-case Wall Street bear target is $290. The current price today is sitting right there at $298.18. Our highly conservative owner earnings baseline, assuming sluggish growth forever, is $335. The analyst average is $399, and the historical bull case is nearly $480.
Based on this triangulation, the asset is trading deep within what we would categorize as the structural buy zone. We would establish that accumulation corridor strictly between $280 and $320.
That's right in the sweet spot.
Yep. At $298, you are acquiring the equity with a significant margin of safety based purely on the cash flows, even if the hyper-growth days are totally over.
I see the math. The math makes total sense. But it raises the million-dollar question, bringing us to Pillar 5. If the conservative math says the baseline value is $335 and we are sitting at $298, essentially hovering just pennies above the absolute lowest bear target on Wall Street,
Yeah.
what is the market terrified of?
There's always a reason.
Right. Why is the broader market willing to sell you this cash machine so cheaply? There has to be a boogeyman in the closet.
That is the right instinct. To understand the market's fear, we have to flip our perspective and outline the exact scenarios that could completely kill this investment thesis. We have to do a red team pre-mortem. What are the kill criteria that would take this from a value play to a value trap?
Let's lay them out. Kill criteria number 1, permanent labor depletion. And we are talking specifically about a structural scarcity of delivery infrastructure personnel.
The entire system relies on cheap labor driving cars. And delivering pizzas is a notoriously tough job. You put immense wear and tear on your personal vehicle, you deal with unpredictable traffic, bad weather, and late-night safety risks.
Not to mention the stress.
Exactly. For decades, there was an endless supply of young workers willing to take that job.
But the labor market has fundamentally shifted. If there is a permanent shift where drivers demand significantly higher base pay, maybe because the cost of used cars and auto insurance has skyrocketed, making the job unprofitable for the driver, it drives the long-term delivery wage scales drastically higher.
And remember the incentive alignment we talked about earlier.
Oh.
The corporate machine only works if the franchisee is profitable. If driver wages skyrocket, the franchise unit margin breaks. The franchise stops making money, they close stores, they stop opening new ones, and the entire corporate royalty growth engine just grinds to a halt. The whole house of cards relies on the driver accepting a relatively low wage.
Which leads right into kill criteria number 2, aggregator dominance. We touched on this, but the true existential threat isn't just that DoorDash delivers tacos. The threat is that the aggregator platforms establish permanent, unshakable ownership of the consumer relationship layer.
Right. Think about how you search for food today. Do you go to a specific restaurant's website, or do you open a delivery app and just scroll?
I just open the app.
Everyone does. If the aggregators completely own the customer no longer opens the Domino's app. They only open UberEats or DoorDash. And suddenly, Domino's is demoted from being a destination brand to just being one of 100 interchangeable options on a screen.
And if the aggregators own the customer, they dictate the terms of survival. Right now, Domino's is massive enough that they've fought hard to negotiate special, low-commission deals to keep their margins intact when they do integrate with these platforms.
But if aggregators achieve total monopoly dominance over the consumer, they could revoke those special deals. They could demand platform commission parity. They could turn to corporate and say, you no longer get a special rate. You have to pay the exact same 30% commission as the local burger joint, or we remove you from the platform entirely.
A 30% commission. If that happens, corporate's royalty margins get squeezed down to almost nothing. The franchisees simply won't have the cash flow to sustain the 5.5% corporate royalty take, the advertising fund, the food costs, and pay 30% to the aggregator. It's a fatal squeeze play.
To understand the likelihood of these catastrophic risks materializing, we have to look past the spreadsheets and look at the internal health of the organization, the soft power and the culture data. How resilient is the human element of this company?
On the positive side, the retention and churn metrics for store operators are genuinely incredible. Domino's relies heavily on franchise retention rather than constantly hunting for wealthy outsiders to open stores. Over 95% of domestic operators are actually promoted from within the system.
That is a staggering statistic. It means 95% of the people who own these multi-million-dollar franchises started as delivery drivers or working the cash register or managing a single store.
They know the business inside and out.
They learned the business from the floor up, saved their money, secured financing, and bought into the system.
That internal pipeline creates a massive structural strength. It creates deep, hard-won operational understanding at the ownership level, which is exactly why their historical store closure rate is below 1% annually. That kind of stability is virtually unheard of in retail food service.
But when we take the inside view and look at the current sentiment data, the facade is showing some real cracks. When we analyze aggregated Glassdoor reviews and internal employee sentiment tracking, it paints a much more complicated, stressful picture today than it did 5 years ago.
First, let's look at the corporate engineering cohorts. The tech teams in headquarters express strong support for the internal modernization initiatives. They like the tools they are building.
Right.
But they are actively pointing out rising bureaucratic friction inside the corporate layers following the 2026 CEO transition. Leadership changes always cause cultural ripples, and right now the tech talent feels bogged down by corporate politics.
And while corporate friction is bad, the sentiment at the ground level is what really concerns me. In-store and delivery personnel are actively citing severe structural strains. They're operating under incredibly tight delivery SLA service level agreement windows.
Explain what an SLA window means for a 19-year-old kid making pizzas.
It means the algorithmic tracking software we praised earlier has become a relentless taskmaster. The corporate pressure to get the pizza out the door and into the customer's hands in exactly 15 or 20 minutes is immense. Store managers are graded heavily on these metrics, so they push the kitchen staff and the drivers to the absolute brink to meet the algorithm's demands. It is high-stress, high-velocity work.
And here is the danger. These workers have options now. That's the competitive gig economy wage dynamic. 10 years ago, if you wanted flexible part-time driving work, you delivered pizzas and dealt with the stress.
You didn't have a choice.
Right. Today, a driver who is burned out by Domino's strict SLA windows and a manager breathing down their neck over a 45-second delay at the oven can just quit. They can walk out the door, turn on the DoorDash app in their own car whenever they feel like it, answer to no boss, and potentially make similar hourly wages.
Domino's is competing for the exact same labor pool as the tech giants, and the tech giants offer more freedom. Which brings us to the ultimate synthesis of all these threats, the fundamental thesis breaker. The core risk is that Domino's historical outperformance was never actually about food. It was merely a function of technological arbitrage.
Let me stop you right there, because technological arbitrage is a heavy concept. Let's ground it. From roughly 2010 to 2022, Domino's stock went on a historic, legendary run, and the narrative was always that they fixed the recipe and built a great app.
That was the story, yeah.
But the arbitrage theory says they thrived simply because ordering food via their frictionless app, tracking it on a screen, and having it arrive reliably was objectively, technologically superior to the alternative.
Exactly. The alternative in 2012 was finding a paper menu in your kitchen drawer, calling a local independent shop, getting put on hold for 5 minutes, yelling your credit card number over the phone to a busy cashier, and then hoping the food showed up sometime in the next hour.
They won because their technology was a decade ahead of the industry standard. They weren't necessarily selling better pizza than the local guy down the street. They were selling a vastly superior ordering and logistics experience. The product wasn't the food. The product was the convenience.
But as we have firmly established today, the aggregators have commoditized that delivery technology for all restaurants. Every single local mom-and-pop shop now has a frictionless, beautiful app interface via UberEats. They all have real-time GPS tracking on the driver. The technological arbitrage gap has closed to zero.
And now that the technology playing field is perfectly level, Domino's is forced to compete in a way they haven't had to in a decade, solely on the product's value proposition, the actual taste and quality of the pizza relative to the price.
And that is a brutal fight. If the convenience is exactly the same, does the consumer choose a mass-produced franchise pizza, or do they choose the artisanal local shop or the local burger joint?
So the ultimate risk, the reason the stock is trading at a massive discount, is an identity crisis. The risk is that Domino's built an incredible tech and logistics company that just happens to sell pizza, but the broader market is starting to price it as just a regular pizza company again.
Yes.
And if the consumer delivery market continues to fragment because every local joint has great tech now, DPZ faces long-term volume stagnation. They transition from being a legendary growth compounder into a low-growth value trap.
That identity crisis is exactly what will define the stock's trajectory over the next decade. The market is weighing the unassailable, highly protected cash flow of the past against a future where the pizza itself has to do the heavy lifting, not the app.
Which brings us to the outro, our synthesis, and our final verdict on the 5 to 10-year shareholder horizon. When we roll all the supply chain advantages, the negative working capital, the aggregator threats, and the valuation together, the quality score we are assigning to the business is high, specifically a grade B+ bid.
It earns that B+ because it is absolutely backed by an asset-light, massively cash-generative operating infrastructure. The unit economics at the corporate level are incredibly robust, but we have to dock it from an A grade because it is increasingly vulnerable to those competitive aggregator dynamics and gig worker labor shortages.
And the valuation score is definitively cheap. The multiple contraction down to 15.6x forward earnings represents a clear, undeniable cycle low. It offers a highly attractive entry point, but only for the investor who truly understands the transition the company is undergoing.
That is the key. You cannot buy this stock expecting the hypergrowth of 2015. Domino's is in the process of completing a fundamental transition. They are morphing from an aggressive growth equity into a mature, highly defensive consumer staple asset. The days of hypergrowth domestic store counts are permanently behind them.
The reinvestment cycle is shifting. The cash won't go into forcing new storefronts into saturated suburban markets. Instead, management will shift that capital toward relentless supply chain efficiency improvement.
Like more automated dough factories?
Exactly, and highly optimized trucking logistics, and trying to capture that international master franchise growth where markets aren't quite as saturated yet.
As domestic retail store saturation officially peaks, management will pivot entirely to utilizing this highly defensive, highly predictable cash generation profile to aggressively fund consistent debt service share count reduction. They will just slowly buy the company back.
So, if you are a patient, long-term shareholder looking at your portfolio, the math looks like this. You have an ongoing 3% to 5% share cannibalization rate from buybacks boosting your equity stake every year. Add in a solid, reliable dividend baseline.
Which is nice to have.
Very nice. Then tack on a very modest, highly conservative, global, mid-single-digit system growth rate. When you compound those three factors together, it implies a highly sustainable 10 to 12% annualized total shareholder return from these current entry levels.
It's not flashy. It's not going to double in a year.
Yeah.
But it is incredibly durable. It becomes a foundational portfolio anchor rather than a volatile rocket ship. The margin of safety is absolutely there at $298, provided the underlying delivery labor model doesn't entirely break.
It's a fascinating evolution of a legacy American brand. But before we wrap up, I want to leave you, the listener, with a final thought to ponder. A massive shift we haven't deeply explored today, but that absolutely needs to be on your radar as an investor in any food stock.
Oh, this is the big one.
It really is. If Domino's is truly transitioning into a defensive consumer staple, how resilient is this hyper-optimized pizza ecosystem to the rising global wave of GLP-1 weight loss drugs?
It's a huge wild card.
These medications are fundamentally altering global caloric intake. If the world simply eats 15% less food, and specifically, if they aggressively cut out heavy, highly caloric processed foods over the next decade, does a highly optimized dough supply chain even matter?
That's the billion-dollar question.
If the volume drops because people literally lose their appetite for the product, the negative working capital cycle unwinds. It is something to mull over as you build your own thesis.
Thank you so much for joining us for this deep dive on synaptic investing. We'll see you next time.